So you have a little bit extra savings and you're wondering whether you should buy stocks or bonds. Well, let's take a look at what makes more sense, in what cases we think bonds are good, and what cases stocks are good. All right, so in the previous video, I looked at the issuing of stocks or bonds from a company's perspective and what can make more sense for them, what they have to consider in this process. But now we're looking at it from the purchaser's standpoint. So someone like you, me, or anyone else can decide whether they want to buy stocks or bonds. There's other financial instruments out there like mutual funds, which is a portfolio that's managed by a portfolio manager that could consist of only stocks, only bonds, or a mixture of the two. But right now, let's just look at the two big categories of stocks and bonds. So as mentioned in the previous video, stocks is you own part of the company. So as that company has big growth potential, it's doing well, it's returning a high profit, that company is going to gain value, it's going to be more valuable. It's as if it wasn't publicly traded. If the company you're building for some reason becomes more and more profitable, and if you were to sell that company to someone else, well, you would sell it for more. So because you own a part of this company, a share of this company, let's say you own 1% of the company, well, if the company doubles in value, if it was privately owned, well, your share in that same kind of respect would also double in value. Stocks change in value daily, well, throughout the day, like as the stock market is open, as people buy, sell stocks. Well, as people buy, it's going to bring up the value of these stocks. As people sell, it lowers the value of the stock. And here, obviously, when someone sells, someone is buying. But if there's a lot of pressure, selling pressure, it's bringing down the value. And if there's a lot of buying pressure, it brings up the value. So stocks reflect the value of the company, and therefore they're good because if there's high inflation periods, let's say we have like a 20% inflation period, well, possibly the company that you own a part of will also grow in value because their equipment that they have within the company can now be worth 20% more. The building that they own could be worth 20% more. Their inventory, everything else can be worth more. So in a certain way, I'm not saying all businesses are like this, but a lot of businesses, the stock that's part of the business is kind of protected from inflation if that value of that business would actually grow with inflation, not because inflation is making it grow, but because the assets of that company and what they're selling is actually also growing in price, because inflation is just a general increase in the price level. Whereas bonds, on the other hand, as I mentioned before, there's this initial agreement. There's someone that issues a bond, a company or the government, sells it. If we're thinking of zero coupon bonds at a discount, and then at a maturity date that is predetermined, that bond has a certain value, let's say $1,000. So in that case, as a company sells it, once it sells it, if you own this piece of bond and you want to sell it to someone else, or someone else wants to sell it to someone else afterwards, well, that's out of the company's control. All that matters to the company is whoever owns this piece of paper, this bond at maturity date, they're the one that's going to receive this predetermined price. So let's say $1,000. So there can be buying of selling of the bonds. It's not as if you buy it, you're stuck with it till maturity. There's other instruments that are like that, but bonds are not like that. You could typically resell them to someone else. So you would think this is a safe instrument. And a lot of people, a lot of financial planners will sell it this way, that bonds are extremely safe. And I agree to some extent. I agree that bonds are extremely safe if you buy it at the beginning and you keep it to maturity, because unless this company or this government goes bankrupt, you're going to get your money back. You're going to get the exact amount of money that was predetermined. However, some of these bonds have been kept talking about situations where the bond matures in a year, but some of them can mature in many, many years. So at some point, you might want to cash out and change your car, buy a boat, whatever. So in that time, you're going to have to sell it to someone else. And when you sell it to someone else, then it might not mean that you're going to get the price that you would have expected at first. let's just give you a broad example here. Let's say you buy a bond that matures in 2 years at 900. That's going to mature and give you $1,000. You would say, well, generally speaking, I expect after a year's time, if I were to sell it, I'd get 950, and then the following year, 1,000. So roughly $50 of interest per year. Well, the thing is that you might not sell it for 950 after a year. And the reason why you might not sell it for that price is that there might be a lot of people that are buying or selling bonds over that period of time. So if for some reason interest rates are going up in the economy, and therefore companies that are issuing new bonds have to pay a greater interest rate, so they're selling it at a deeper discount, well, this bond that you own that was selling for $900 can drop in value. If all of a sudden this bond is no longer desirable because you used to get 5% yearly and now they're giving 10% yearly for the same company, well, your bond's gonna drop in value. And you should see kind of like the implied interest rate over the course of the duration is based on that distance between the price you pay and the price at maturity. This price doesn't change, but the lower this price becomes, the greater the gap you have for the same time period to reaching $1,000. So when price of bonds fall, the implied interest rate is going up. So all in all, bonds are good instruments. They're safe if you keep them to maturity. The amount of return you can get from bonds is not necessarily as high as what you would get from stocks, depending on the stocks, but they're safer to some extent if you keep it to maturity. The challenge with bonds is if they lose value in the process and you have to sell them before maturity. And that typically happens when interest rates are rising. Because as interest rates in the economy, the bank rate, and all the other interest rates are rising, typically borrowers, such as these large companies, will have to pay a greater interest rate to emit new bonds. And therefore, the one that you bought that had a lower implied interest rate would drop in value to reach the same kind of value in terms of interest rate as the other ones. So you could buy a bond thinking it's very safe and sell it a few months later and have to sell it cheaper than you expected. So that's one of the bad things about bonds. The second thing to consider with bonds is that you have this predetermined price at the end. And in most cases for all of these bonds, that predetermined price does not change with inflation. Therefore, bonds are not sheltered from inflation in the sense that if for some reason we have this really high inflation level throughout this process, so you buy it at 900, you want to sell it 1,000 2 years later, and over this time period you have 20% inflation, well, that 1,000 you get at the end is like roughly like 800 equivalent of what it is now. Therefore, you're seeing your value drop. It's not protected by inflation. So your real interest rate would be actually negative in that case. So just something to consider. So two different options. Bonds are definitely safe if you keep it to maturity. They also tend to keep their value if interest rates are falling. Stocks are more inflation adjusted. They're riskier. Any government policy that changes, such as introduction of tariffs or other things like that, can really drop the value of stocks really rapidly, any bad news events. So keep that in mind. So those are the two different tools and the kind of implications of each. Hope you found this interesting. Catch you in the next one. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real life examples. Have a good day.